Welcome to the Cash Stream Financial video, the credit crunch and its effect on small business in Australia. My name is Tim Lee and I'm the CEO and founder of Cash Stream Financial, specialists in raising cash flow finance. In this video we're going to look at the causes of the credit crunch and its effect upon small business within Australia. You might be interested to know this video is part of a series of videos relating to commercial finance which are available to view in the Learning Centre of our website cashstream.com.au. So let's get started. What exactly caused the credit crunch? Fundamentally, it was the weakness in the subprime market in the US that led to the credit crunch. It all started with the housing boom in the US, essentially a byproduct of many years of economic growth. As a result of the housing boom, new financial products were explored, that of offering those of weak credit the opportunity to buy into the market, the subprime. Highly competitive terms were offered, with low introductory entry costs and long mortgages, up to 40 years. These loans were then packaged up, and with some clever financial engineering, primarily through credit enhancements, they were sold as AAA-rated investment vehicles. AAA rating is the highest investment rating you can get. Then inflation began to rear its head, and the Federal Reserve began to increase interest rates. This coincided with many entry-level deals in the subprime reverting to default rates, placing pressure on the subprime borrowers and opening up weaknesses in the housing market. It then became a self-reinforcing cycle. The falling market led to a rise in defaults, and many of the loans to the subprime sector were on what is known as a non-recourse basis. What this means is that the lenders only have the property to fall back on. They can't go after the borrower themselves. So weaker borrowers had nothing to lose when the going got tough, and simply handed the keys back to the lenders. This led to a sharp rise in defaults in the subprime sector. Which in itself led to smaller mortgage lender failures. This in turn led to interbank losses, both directly from the funding of the failed mortgage lenders, but also from the securitized bonds that had been purchased. Now fear is a powerful emotion, and confidence began to wane, as companies tried to unravel who had exposure to the subprime sector. How exposed were the banks and the investment banks? With 15% of all residential mortgage loans being subprime, it was becoming a major problem. Australia only had 1% subprime. And then the banking failures started to happen, and this has a domino effect. There were major banks that started to fail, for example, Lehman Brothers. CBA reported a $150 million loss on Lehman Brothers, NAB $100 million, ANZ $120 million, and that's just one bank. It begged the question, who was next? Now the whole banking system is based on one key factor, confidence. And as Oscar Wilde so appropriately stated, confidence is like virginity. You lose it only once. And if no one has confidence, it spreads like a cancer. So why did this cause banks to stop lending? Surely they had monies they could lend. They've been profitable over many years. Well, to explore this, we need to consider how banks fund themselves. Finance institutions have four principal sources of money to lend out. Firstly, their existing equity, from historic years of profitability and the initial shareholders' funds. Secondly, there is interbank borrowing, where they borrow money from other banks. Thirdly, with those with banking licenses can take deposits from the general public and from business. And finally, there is securitisation, where the loans that they have made are parcelled up and sold into the financial markets. But what happens if interbank lending dries up? And if there's no investor interest in securitisation investments? And what if you don't have access to cash deposits, as is the case with most second and third tier lenders? All you have access to is your own equity, and there then becomes a credit crunch. For a moment, let's just turn to bank deposits. You may have noticed increasingly over the last 6 months or so, banks have been aggressively chasing bank deposits. Now you know why. So how is all this affecting small business? The key thing is that funds for all institutions to lend have been restricted, and as with any limited resources, price will rise. What you also find with limited resources is that credit becomes tighter, as we're beginning to see right throughout the marketplace, especially with the second and third tier lenders who have wholesale funding lines. We are hearing of tighter covenants and controls being put in place on even those wholesale funding lines. So if you're looking for finance for whatever reason for your business, be aware it will be harder and more expensive to raise finance. So get professional advice before you look for finance for those that are in the market every day, because you'll find that risk is being priced into every single deal, and the SME sector is viewed as very risky. So what about the future? Whilst the US government is instigating positive action, fear does not go away overnight, so the credit crunch will probably be with us for quite some time. We're also beginning to see the Australian economy beginning to slow, with the effects of America and Europe beginning to have their effect on China and ultimately the Australian economy. If the economy does take a further downturn, we will notice there will be an increased tightening of credit as the banks begin to see more losses. It all sounds incredibly depressing, and it's not meant to be that way, but the problem will not go away overnight. So the key thing is be prepared for a difficult battle ahead, and be prepared for increased difficulty in raising finance. And as the military strategists always suggest, in peace you must plan for war. And remember, it's easier to raise finance when you're not desperate for it. So plan. Talk to your external advisors about the financing options open to you, or to a specialist who is in the market all the time.